You sure? Okay. Hi, everyone. Welcome to the stream today and welcome to a new month, September. We're already getting excited for the November 2025 examination. We are currently in the 4th week, and it tells you that we have about 8 more weeks to go. So we have September, October, boom. Then we are done and we should be ready for the November 2025 examination. We are starting with our IFRS masterclass discussion, and that is going to be coming in with some other discussions where we're going to be solving questions in respect of the various key standards that you have to be mindful of and the various areas that you have to pay attention to put yourself in the position to go into the exam hall, write the exam with confidence, and most importantly, pass the examination. And so, welcome to the stream. If there are any questions you have, something you want to pick my brain on, you can put it in the comment section or the chat box. Also, remember to share the video. Let's reach as many students as possible. So share the video on your WhatsApp groups, on your study groups, Telegram pages. Just share the video as much as you can so that we get excited into the discussion. Remember that our enrollment is still ongoing. So if you have not registered and you want to register to join our community, study under my mentorship, get access to our content programs and everything, you can call us on WhatsApp or you can send us a message or visit our website, NhyiraPremium.com, and you'll be able to complete your enrollment. So let's get excited into the discussion today. We're going to be looking at IAS 32, that is Financial Instrument Presentation. We will share some thoughts on IAS 2, that is inventories, and then we'll come to IAS 23, borrowing costs. So a number of accounting standards we're going to be looking at, practically referring to questions, solving the questions, and then highlighting on some of these principles that you need to generally understand. So let me bring up my screen quickly and let's get excited into the discussion. Now, the question we want to look at is an ICAG past question. You can scan the QR code on the screen to be able to download it. So if you have a good device, you should be able to scan the QR code and you will be able to download this question. Alternatively, it is also available on the ICAG website. This is the ICAG Financial Reporting March 2025 question. We are focusing on question 2, where the accounting standards are, because we're going to be having 20 marks question on the accounting standards, and it is important we understand these very well. We want to start our discussion from the D aspect of the question, so question 2D, and it is 6 marks there that we have. Now, per the time allocation, give me a moment. So when it comes to time allocation, 6 times 1.8, it means you need about 11 minutes to work with this. 11 minutes. So speed and accuracy is going to be crucial in order for you to really pass the examination. So we are going to be doing this, or we are expected to do this in 11 minutes. So let's look at the requirements of the question. It says, determine the value of the liability component and the equity component of the bonds at 1st January 2023 to the nearest one Ghana city. And so by reading this, if you are strong in the accounting standards, if we have to determine equity component and liability component of a bond, what it means is that the entity is issuing convertible bond. And if an entity is issuing a convertible bond, it means that we are going to be referring to IAS 32, Financial Instrument Presentation. And as per the guiding principle in IAS 32, Financial Instrument Presentation, when an entity issues convertible bonds or convertible loan notes, the proceeds must be splitted between the debt component and the equity component. The question we ask ourselves is, how do we get the equity component? How do we get the debt component? It's simple. The debt component is derived by discounting the cash flows on the debt to present value, using interest rates of similar bonds without conversion rate, or the effective interest rate. That is very important there. So that is the rule when it comes to how we get the debt component. So we're going to be discounting the cash flows on the bond using the interest rate of similar bonds without conversion rate, or the effective interest rate. That is what will give us the debt component. Once we have the debt component, the equity component is simply going to be the proceeds minus the debt component. And that is what is referred to as the initial measurement and recognition. Initial measurement and recognition. So that is IAS 32, the principles. Now, the reason I replay that quickly is because when you read a question and you read a requirement, you should be able to draw the principles quickly before you get goosebumps into reading the question itself, because that is how you can then work with speed and accuracy. So the trick here is that we are calculating debt component and equity component of a bond. Since that is what we are doing, it means that we are going to be applying IAS 32 financial instrument presentation, and to get a debt component, we discount the cash flows on the bond at the interest rate of similar bonds without conversion rate, or the effective interest rate, so that our equity component becomes the proceeds minus the debt component. Let me add this quickly before we go, that where there is any transaction cost, okay, in other words, the entity incurs some cost in issuing this convertible bond, transaction cost will just be allocated between the debt and equity component. Okay, it will be allocated between the debt and equity component. That's the principle we must understand. What does that mean? It means you first have to split the proceeds between the debt and equity. After you get that, then you can split or share the transaction cost as well. So you don't subtract the transaction cost from the proceeds and then decide to share the net amount. No, you share the proceeds. After that, you allocate the transaction cost between the proceeds, between the debt component and the equity component. These are the things you must understand when it comes to dealing with IAS 32 financial instrument presentation. So now that we have the principles in respect of what we are expected to do when it comes to initial measurement and when it comes to initial measurement, let's go back to the question and then see how we can apply the principles. Acclaimed Limited issued, so Acclaimed Limited issued 20 million of 100 Ghana Cedi 9% bond at par. Remember, bonds can be issued at par, meaning they are issued at their face value, okay, or they are issued at the nominal value. It's the same thing. So the bond can be issued at par or at face value or at nominal value. What does that mean? It means that the value quoted on the bond is what we are getting. So in that case, the proceeds is the same as the value of the bond. But bonds can also be issued at a discount. When bonds are issued at a discount, it means the bonds are issued at below their fair value. The bonds are issued below their fair value. So in that case, the proceeds will be less than the nominal value of the loan notes. So these are the two things you must understand. But here, the bond is issued at par on 1st January 2023. Let's continue. The maturity date of the bond is 31st December 20X6. Okay, so we can get goosebumps and begin to put out certain things. So let me bring up my slide quickly. Let's go. Aquele and Obake Limited. So Aquele Limited. So this is the D aspect of the question that we are looking at. And so first step is to calculate the debt component. So we'll have the year coming in for us. Then we will have the cash flow here. Then we'll have the discount factor. Then we'll get a present value in the last column coming in like this. Now we slash in our currency sign. Tell the examiner we'd like to work 3 zeros up, 3 zeros up. Now the bonds were issued, or the bond was issued on 1st January 2023. And it will be redeemed, or maturity date is 31st December 2026. So let's continue to read, then I'll come back. At that date, the bonds are redeemable at par, so they can be redeemed at par, or convertible into ordinary shares. So that is emphasizing that this is a convertible loan note. Then the examiner said, converted to ordinary shares on the basis of 14 ordinary shares for each $100 bond. We don't care. Okay? We don't care. In the context of the requirement of this question, we don't care about the conversion basis, but it is part of the story, and so the examiner will always, or almost always, bring it. The market interest rate. Now, also note that, let me say this quickly, then we go. Bonds can be issued at par, meaning bonds can be redeemed at par, meaning at the face value or at the nominal value. Bonds can also be redeemed at a premium, meaning above the face value or above the nominal value. So those are little things you have to be mindful of. Let's continue. The market interest rate for individual bonds with no conversion right would have been 5.5% every 6 months. 5.5% every 6 months. Coupon interest is paid in 2 installments of 4.5% in arrears on 30th June and 31st December. So this is semi-annual situation coming up here that we need to understand. And so in the context of this question, there are 2 ways we could decide to approach the question. But you have to be careful, because although we have the annual interest rate, we have been given the semi-annual rate. So if you check the workflow, bond will be 31st January 2023, and will be redeemed on 31st December 2026. So how long is that? So we have 23, 24, 25, 26. So it is going to be 4 years. All right? Now, although it is 4 years, because interests are paid semi-annually, it means when it comes to the period, it is going to be 8 periods. I hope you are getting the picture. So it is 4 years. Bonds will be paid semi-annually, so it becomes 8 periods. And so because of that, in the context of this workflow, we wouldn't say years, we will work in periods rather. Periods. And so from period 1 to period 8, the interest will come that they're going to be receiving every year, which is the cash flow usually. Now, so if you check, the bond is 20 million. So every month or every 6 months, so interest for the semi-annually or on semi-annually basis will be the 4.5% times 20,000, because we are working 3 zeros up, right? 0.045 by 20,000. and that is 900. So every period, 900. So 1 to 8, we have 900. Then in the 8th period, we are going to bring in the redemption. Now, so I'm using annuity here because when you are receiving the same amount of money over a defined period or defined number of years, we use annuity. So 1 to 8 is annuity. Other than doing it 1, 2, 3, 4, 5, that will be plenty. So I just want to apply annuity and go away. That doesn't mean if you decide to do 1, 2, 3, 4, 5, 6, 7, 8 vertically, you are wrong. You are still correct in that case. So let's go in there. We are told it to be redeemed at par. So in the final year, the nominal value of 20,000 will come. Then we need a discount factor. Remember, we are told that interest rate of similar bonds with no conversion right is 5.5%. So that is the effective rate, 5.5%. Graciously, the examiner has given us the discount factor cumulatively. So we are focusing on 5.5 for now because that is the rate we are using. So you see that the examiner has multiple rates available. 4.5 is there, 5.5 is there, 9% is there, 11% is there. But we use interest rates of similar bonds without conversion right, which is the 5.5. So you got to be careful there. And so the 8th period, the rate here is 6.3346. So 6.3346. All right. Then the 8th period, that one we won't use the annuity factor, we'll use the present value. Now, there are two ways you can get that figure. You can check the difference between the 7th period and the 8th period. The difference between that will give you the discount factor for the 8th period. Or you can calculate it yourself. Let's do the two. Let me explain it to you because it's the context of the question and how you dance. So if we do 6.3346, which is the period 8, then subtract period 7, 5.6830, that is going to give me 0.6516. So that will be the discount factor for period 8, 0.6516. But if we don't want to, if that is a little complicated for you, then you can just use the present value formula to get a discount factor. So discount factor, we are looking at the period 8. That's 1 over 1.0055 exponent 8. Okay, exponent 8. So 1 divided by into bracket 1.0055 exponent 8. Oh, I did exponent 2, Nhyira. Exponent 8. Oh, no, give me a sec. 1 plus 0.055. Not 2 zeros, just 1 0. It gives you the same answer, 0.6516. I hope you get a treatment. So either you calculate it this way, or if it is given, then the difference between the annuity for 8 minus the annuity for 7 give you the discount factor for 8. This is a fundamental principle that you must understand. So now that we have these, we can then multiply it up to get the present values respectively. So 900 times 6.3346, I'm getting 5701. Then 20,000 by 0.6516, 13,032. So we add the present values up, and that gives us the debt component. Okay, so the total present value gives us the debt component. And so plus 5701, that's going to be 18,733. Then we bring in the proceeds. Remember, this debt was issued at par. So the proceeds we got will be the nominal value, which is 20,000. The balancing figure becomes the equity component. Minus 20,000, and that is 1267. So this is the A aspect of the question, the I aspect of the question. Determine the value of the liability component and the equity component of the books at 1st January 2023, of the bonds at 1st January 2023. So that is the I aspect of the question, and really that is initial measurement. See, that is not difficult. Very sweet, simple, straight to the point. We're done. And this is what I was saying, that assuming we had transaction cost, then we will now allocate the transaction cost between the debt and equity using the values we just calculated. That's the idea about that. Now we go to the II part, which is going to actually take us to subsequent measurement. It is determine the value of the liability component at 31st December 20X4. Got to be careful here. At 31st December 2024. Now, on subsequent measurement, the liability component is carried at amortized cost. That's the rule. The equity components remain at the same amount initially measured until the date of redemption. That's it. Okay? So, on subsequent measurement, we're going to apply the amortized cost. So, we get a carrying amount of liability component at 31st December 2024. And so we can do vertical approach or horizontal presentation. So we're going to have the period end here. Then we'll bring balance brought forward. Now, interests are paid in arrears, right? If you check the way interests are paid, we are told that June and 31st December. So interests are paid in arrears. So you bring balance brought forward, then you bring the interest that we are supposed to pay, and then we bring the interest that we paid. And then we can get a balance brought down. That's the idea. So we slash in our currency sign. Now, so what is going to happen is that the interest, this interest is based on the effective rate, and that will go to P&L, and the amount we pay is the coupon rate. All right? That's the idea. So let's go. First, the bond was issued in 2023. So we can then bring 2023, 30th June 2023. That will be the first 6 months. The initial measurement figure for the debt, 18,733. The interest, which is going to be our effective interest rate of 5.5%. So we apply it, 18,733, and that is going to give us, 18,733 times 0.055, and that is 1,030. But remember, the interest we pay every year is 900. So we take it out. Arithmetically, we get a balancing figure for 30th June 2023. And that is 18,863. Then we do for the next 6 months. That will be 31st December, still 2023. So the closing balance for the 30th June will come as opening for us in December workflow. So 18,863. Then we apply the effective rate 0.055. That will be 1037,037. Still, the payment we make every 6 months is 900. So arithmetically, 18,863 plus 1037 minus 900, and that is 19,000 for us. Remember, the year ended they said we should work for is 31st December 2024. So that is what we are going to be working for. So let's proceed. The next period is going to be 30th June 2024. So the opening will be 19,000. Effective rate of 5.5%, 0.055. That is 1045. We're still going to pay 900 on 30th June 2025. So we get the arithmetics. And that is 19,145. 19,145. Then we need a final period, 31st December 2024, 19,145. Then effective rate, 0.055. And that is 1053. Then we less than 900. We get the arithmetics. 19,145 plus 1053 minus 900. And that is going to give us 19,298. 19,298. So, the answer to the question on II says determine the value of liability for the bond. So the value of liability of the bond is that figure there. So the value of the liability component of the bond is 19,298,000. This is the answer to the question for 6 marks. And you are doing this in 11 minutes. And that is IAS 32, Financial Instrument Presentation. When an entity issues convertible loan note or convertible bond, initial measurement, we do the split, and then subsequent measurement, the debt is carried at amortized cost. The key thing here is that payment for the loan is being done semi-annually. And so that's why we are working. If it was annually, you would have just seen 2 years, but semi-annually, so we are doing 4. If the question has said quarterly, then every year you are doing 4. So there is no problem here. If it says annually, it's 1, period. If it is semi-annually, 2 in every year. If it is quarterly, 4 in every year. So the law is the law is the law, right? So that's the idea. So that's our answer to our question. And let me know if there are any questions in respect of this. Any clarity you want in respect of this, you can put it in the comments or the chat for me, and I can bring that up and provide you with some answers as we continue with the discussion. Okay. So let's go back up. So that was D of the question. Let's go to B, the B part of the question, and see what we have there on the B part. The B part of the question, it's about IAS 23, borrowing cost, one of the fundamental accounting standards when it comes to dealing with non-current assets. So let's see the requirement. Together, the B part is also 5 marks. So technically, we are working with 9 minutes. Yep, 9 minutes for that. So let's see. It says, state the conditions under which borrowing costs can be capitalized. State the conditions under which borrowing cost can be capitalized. Now, usually, an entity borrows money, and when money is borrowed, the interest or the cost we incur on the money we've borrowed is what is referred to as the borrowing cost. If we borrow the money to finance the activities, the general activities of the entity, like payment of wages and salaries, payment of our suppliers and other expenses, that's not a big deal. Any borrowing cost incurred will just be written off in the profit or loss account for the year. That's all. However, when an entity borrows money to finance the acquisition, construction, manufacturing of a qualifying asset, then the borrowing cost incurred on that loan must be capitalized. But it is important to understand that the fact that the money has been borrowed to be used to finance the manufacturing, construction of a qualifying asset does not mean all the borrowing costs and or interest expenses will be capitalized. And so what are the conditions that must be satisfied before we can capitalize borrowing costs? Certainly, borrowing costs are being incurred. Then the expenditure is being incurred, but most importantly, activities that are necessary to prepare the asset for its intended use or sales are ongoing. So if the activities required to prepare the asset for its intended use or sales are ongoing, we are incurring borrowing costs, we are paying for the expenditures, then boom, the borrowing cost must be capitalized. That is the answer to the I aspect of the question. So activities necessary to prepare the asset for its intended use are ongoing. 1. 2. Borrowing costs are being incurred. 3. Expenditures are being incurred on the activity. That is what we mean by the I aspect of the question. State the conditions under which borrowing costs can be capitalized. Then we come to the II part of the question. And if you remember, I keep saying this, that you don't just learn the standards with the calculation part. There are theories in the standards as well that the examiner can throw at you. Okay? So it is important you have an understanding of the theory part and not just be caught up in the calculation part when it comes to dealing with the accounting standards. So let's look at the II part, which is the calculation part of the question. It says, calculate the amount that should be capitalized as borrowing cost for the financial year end July 2024. So remember, the question said borrowing costs that should be capitalized. In other words, it relates to the period where there is active work ongoing, borrowing costs are being incurred, and expenditures are being incurred. And these things are mutually inclusive. So it's not like either or. All of them must be there before we capitalize. Okay, so let's go. So this is B, II. We are calculating for the borrowing cost to be capitalized for the year ended July 31st July 2024. Okay. So let's go read the story. Now we know the principle. IAS 23 borrowing cost set out the conditions under which borrowing costs should be capitalized or expensed. Okay, should be capitalized or expensed. On 1st August 2023, Fosti PLC commenced construction of a factory for its own use. Now, I need you to pay attention here because there is a little nuance in this particular question, but I need you to pay attention well. Fosti PLC commenced construction. So we are seeing the word commenced construction on 1st August 2023. Now, when is 1st August 2023? 1st August 2023 is at the beginning of the year because the year ended is July 2024. So if the year ends in July, then what is happening is that it starts in August 2023. So let's go. On the same date, it issued 5% loan note for 40 million. The entire proceeds of the loan were used immediately to pay for the land and to purchase building materials for the project. Okay. So if you are not careful at this point, you are going to conclude that, oh, they have commenced construction, they have paid, they have issued a loan, and all the proceeds for the loan was for the project. So it means all interest expenses should be capitalized. Then we are told that they bought a land. They bought material for that project. But look at the final sentence. Construction work commenced on 1st October 2023. This is a nuance I'm talking about. So they said on 1st August 2023, Fosti PLC commenced construction of a factory. Then now in the second sentence, it is saying construction work commenced on 1st August 2023. So the question that we ask ourselves is this. When should capitalization start? As we said, capitalization commences when the assets or the activities that are necessary to bring the asset to its present use or condition are ongoing. What does that mean? It means that we will start capitalization from 1st October 2023 because that is where actual construction work commenced. Principles. So let's go. And continued throughout the year, except for a half-month break in December 2023 and a further half-month break in July. If you remember in IAS 23, the principle is that where there is stoppage or halt in the project, and that halt is not necessary, then the borrowing cost should be written off in the P&L account and not capitalized. So if we come back to that, we started construction in October. So you will say, okay, 1st October 2023 to 31st July 2024, which is the year ended. How long is that? October, November, December, January, February, March, April, May, June, July. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So it's like 10 months. So the period is 10 months. But be careful. They said there was half break in December, another half in July. So half full. So it means that we will capitalize only 9 months. So active work will be 9 months. So just some English here. You don't need this in the exam, but I'm in class, so permit me to flex a little bit. So the construction period, you don't need to write this in the exam, okay? But I'm in class, so permit me to teach you and explain this to you. So the construction period is 10 months. Okay? It's 10 months. The construction period is 10 months, which is from 1st October 2023 to 31st July 2024. However, there were breaks or half-month breaks in both December 2023 and July 2024. As such, the capitalization period will be 9 months. Okay? 9 months. Being the 10 months construction period minus the 1 month break. That's the idea. And so in that case, what will happen is that we will now calculate the borrowing cost to be capitalized. So borrowing cost to be capitalized will be equal to how much? 40 million. No, Ghana Cedi Nhyira. So 40 million times the interest rate was 5%, 9/12. All right? So 40, 0.05, 9/12, and that's about 1.5 million. This is the answer to the II part of question 2B, borrowing cost. Very sweet, simple, straight to the point. The only complexity, if I can put it that way, in this question was what I highlighted earlier, that it looks like they said, oh, construction was started on 1st August 2023. Then they said, construction work commenced on 1st October 2023. Okay, that is better light thrown on the discussion. Then there were 2 half-month breaks. Half-month breaks together gives us full year, hence 1 month break, and that is the answer to the question. So this is the treatment for this. 3 marks. Very sweet, simple, straight to the point. And so you are seeing that in each of the questions we are looking at, the examiner is trying to, if you want, sprinkle some onions, right? Some sweet pepper, some, try to garnish the question because it is an exam. So the question has to be spiced up a little bit. And if you don't really understand your principles, you're going to get Zokbo. And that is the beauty of the exam. Yeah, I know you're going to say, it's not beautiful, Nhyira, but it is. It is beautiful. All right? So that is B aspect of the question. Let's look at the next one. The A aspect of the question, and that is IAS 2 inventories. IAS 2 inventories. So requirement. I part of the question is a written question for 2 marks. Now together that is 6. So in total, the A aspect, we need 11 minutes. So I says, identify 4 situations in which net realizable value is likely to be less than cost. Remember, the default treatment for inventories in IAS 2 is inventory should be carried at lower of cost than net realizable value. So the examiner is saying that what are some of the situations, what are some of the circumstances under which the net realizable value will be less than the cost of the asset? A number of things. If there is obsolescence in the inventory, certainly then the net realizable value will be lower than the cost of the inventory. Okay, physical deterioration, then certainly the net realizable value will be lower than the cost of the assets there. Then we can talk about the issue in respect of a fall in the selling price of the product. So if we expect, originally we should have sold the product for, say, $10 per unit, and now it is sold at $7 per unit, the fall in the selling price will result into the net realizable value being lower than the cost of the asset there. And then certainly the issue in respect of error in production, or if you want purchasing, that can also cause this. So these are some of the circumstances under which the net realizable value of an asset, of inventory, will be less than the cost. So deterioration, physical damage, okay, reduction or a fall in the selling price of the product, and certainly error in production or error in purchasing. These are some of the situations in which net realizable value is likely to be less than the cost of the inventory. So that was a written part. So again, if you are paying attention closely, the A aspect, there is a theory question of 2 marks. The B aspect, there is a theory question of 2 marks. If you come to C, that is purely written question. Then you come to D, that one is purely calculation. So it is letting you have an idea and understand that as you are walking into the exam hall, it's not going to be, hey, calculation. No. There are going to be theories on the accounting standards. Now, this is exclusive of the dedicated theory areas, 20 marks that you need to know about. And that is how you study. Knowing that, some theories will even come on the standard dedicated plus theory dedicated 20 marks that you need to be mindful of. And these are the things you must understand and how you study. So when you are learning the standards, please don't just be about calculation. The theories under the standards, the discussions under the standards, be mindful of them as well. So let's come to the II part, which is your favorite area because it's a calculation area. Let's see what we got. It says, calculate the closing value of inventory at 31st December 2024 and show how it should be accounted for in the statement of financial position and the statement of profit or loss. Okay, so calculate the value of the closing stock. How should it be accounted for? Let's see. IAS 2 inventories prescribes the accounting treatment for inventories. It provides guidance on the determination of cost and its subsequent recognition as an expense, including any write-down to net realizable value. Ms. Christiana Addo, the managing director of Malik Limited, has a number of specific queries in relation to inventories and has asked you for professional advice in relation to IAS 2. Malik Limited's inventory at 31st December 2024 is 345,000 Ghana cedi. Okay, so let's begin to get some excitement here. So II, and that is question A. II. So Malik Limited It's like slashing the currency sign. So let's bring in the closing stock at the reporting date. And that is 345,000. Very nice, like that. Let's continue to read. It says, this includes 4,600 for items accidentally destroyed on 31st December 2024 after the count was completed. Oh. Accidentally destroyed. Okay. If it has been destroyed, then it doesn't form part of the closing stock then. So since it was included in the 345, we have to subtract it. So we less the inventories accidentally destroyed. 4,600. Let's continue to read. Also included is 2,900, which relates to the cost of inventories damaged, in October 2024. Okay, the year ended is 31st December 2024. So these inventories were damaged in October 2024. So October, November, December. So 3 months ago, these inventories costing 2,900 were damaged, which can be reworked at a cost of 600, and which can then be sold for 2,400. Okay. So you got to be careful about what is going on here. That the inventory that were damaged is valued at 2,900. But we can rework it, and when we do, we can sell it for 2,400. But that will require a cost of 600. So cost to sell of 600. So the net realizable value on the damaged inventory will be what? 1,800. So let me work it out here for you so you get the understanding. So damaged inventories or damaged inventory in October. So the cost of the inventory was 2,900. Remember, this inventory is already included there. But then let's get a net realizable value of that inventory. Net realizable value. The net realizable value here is going to be the selling price or sales after repair which is 24. Then we less the cost of repair, which is cost to sell. $600. So that the net realizable value of the damaged inventory will be 1,800. Stay with me. Inventory should be carried at lower of cost than net realizable value. So if you compare the cost 2,900 of the inventory that was damaged to the net realizable value of 1,008, it means the inventory should be carried at what? The lower of the two, which is the 1,008. Now, that 2,900 is already included. So what it means is that the inventory must be written down by the difference. So 2,918, that's 1,001. And that is going to be the inventory right down. 1,100. I hope you get a picture of the workflow. So the portion of the inventory that was damaged in October cost 2,900. What is the net realizable value of that inventory? Because they can rework it and sell it. Look at the difference between the damaged inventory and the ones that were accidentally destroyed. The ones that were accidentally destroyed could not be sold. So that's why the 4,600 was directly subtracted. But the one that was damaged in October, that one could be sold after some rework. So you have to compare the cost of the inventory and the net realizable value after we rework and sell it. And the lower of the two is the net realizable value. So we have to write down the inventory by 3,100. On the basis of that, the closing inventory at the reporting date, which will go under statement of financial position in current assets. So closing value of inventory will be 345,000 minus 46 minus 1,100, and that is 339,300. Okay, 339,300. So that is the value of the closing inventory that will go on the face of the statement of financial position under current assets. Then, now remember the context of the question, because it says, show how it should be accounted for in the statement of financial position. So in the statement of financial position, this is the closing inventory that will go under current assets. Then it says, and in statement of profit or loss. So in statement of profit or loss, the write down of inventories will be taken to the statement of profit or loss as part of cost of sales. So statement of profit or loss, extract, as part of cost of sales, we are writing down the inventories by the two figures, which is the 4,600 and then the 1,100. And that together gives us 5,700. It's an expenses, so you put it in brackets. This is the answer to question 2AII. Calculate the value of closing inventory at 31st December 2024 and show how it should be accounted for in the statement of financial position and the statement of profit or loss for 3 marks. For 3 marks. So again, I keep saying this. Speed and accuracy is crucial if you are going to be successful in the exam hall. If you're a slow person, you toast it. If you read and you cannot call the principal, it's over for you. So you have to build the knowledge and understand the principles very well. And that is why the summary videos are available. Okay? So you watch the summary videos on the standards. On our portal, right, in the mobile application, you watch the summary videos on the standards. Then once you watch the summary videos on the standards, understand the principles like this, then you look at the questions that have been solved. Then you expose yourself to more questions, and that is what you need to look out for. So these are the things you must understand. IAS 32, financial instrument presentation. IAS 23, borrowing cost, capitalization of borrowing cost, and then IAS 2, inventories, how we calculate the closing stock of inventories. Using the principle we know already that inventory should be carried at lower of cost and net realizable value. These are the things basically you must understand when we talk about these standards. Give me a sec, let's see. So any other questions for me real quick? Any other questions? All right, coming up. Because I want to pull up. Okay. So that's it about that. And we'll wrap up here today. I'll be coming on the stream again on Wednesday. And we'll look at some other questions still on the standards and look at some other questions. So join me same time, 4:30 p.m. or 14. Did I say 14? 16, right? 16:30 GMT, live on YouTube, on Facebook, as well as on LinkedIn. And we will continue with the discussion in respect of that. If you want to get access to our full lecture videos, our summary videos, get access to join our live lectures and all that, you can send us a message on WhatsApp 050-114-9296 or visit our website, NhyiraPremium.com, or you can download the Nhyira Premium mobile application and complete your enrollment so you can join our community. Let us assist you, hold your hand so you can pass the examination. We also have copies of all of our books available. So public sector, financial reporting, corporate reporting, strategic case study, taxation, management accounting. So all of the books on the courses in level 2 and level 3 are available. We just received some new stocks today. So you can also send a message about it and you will be assisted so you can get copies of the books to help you to study as we prepare for the examination. Remember, we are in the 4th week, so we have like less than 8 weeks to go. So you want to make sure that you are studying, and you are committing at least 8 to 12 hours every week for each of the subjects that you are writing. And that is how you can put yourself in a position to go and pass the examination. Please do not wait a week to the exam and take a leave and think you can do everything in 1 week. You're going to burn out, you're going to struggle, and most importantly, you're going to go into the exam hall and the results will come, and there is a 99.9% probability that you're going to fail. So you don't want that. So start studying on time, get access to materials that will help you well, and be guided and be mentored so you can pass the examination. Thanks for watching, and I'll see you same time on Wednesday, 16:30 or 4:30 p.m. as we continue with the discussion. Stay safe and stay blessed.